Hello again. We're going to be talking today about Cooper and John textbook, chapter 18, and we're going to finally begin our exploration of macroeconomics. Some of our learning objectives for today. We're going to look at how do we measure the total output of an economy. What's the difference between real and nominal GDP? And we're even going to learn what GDP is. We're going to find out how price indices, such as the Consumer Price Index, are actually calculated. And we're also going to look at the difference between the CPI, the Consumer Price Index, and the GDP deflator. And finally, we're going to look at some of the difficulties of measuring changes in price. Now, first off, your book opens the chapter with a brief little look at Argentina, and you pretend that you show up in Argentina and you're supposed to find out, is it a healthy economy? Because you're working for the International Monetary Fund, a large bank that covers the whole world. So your big question is the Argentine economy healthy? And how much is it producing? And is it growing? Well, the study of things like that is exactly what we call macroeconomics. It's the study of the performance, the structure, the behavior, and the decision-making of an entire economy. Prior to this, we've been looking at individuals and at individual firms, and now we're going to look at how those all operate in the aggregate. Specifically for this chapter, we're going to care a lot about economic activity, which is essentially all the goods and services in an economy that are produced for sale. Now, if they're not produced for sale, then they kind of don't count in the economic activity, at least when we're thinking like an economist. And one of the best ways that we can ultimately measure that is in something called the gross domestic product. And as we move through this video, we're going to learn that the gross domestic product is the same thing as the economy's total income, which is the same thing as the economy's total production, which is the same thing as the total spending by all households in the economy. Now, we're going to prove that. You don't have to fully understand that yet, but that's just a reminder of how we're going to get there. Now, how do we measure things in economics? First of all, we just have to remember that there are two ways of looking at piles of things. Okay, whether it's piles of dollars or piles of marbles or piles of blue jeans, there are two ways to think about it. We can measure stocks, which is any variable that can be measured in principle at any given point in time. So how many blue jeans are on that shelf right now? As opposed to something we call a flow. That's a variable that's measured over a period of time, over a particular interval. How many blue jeans did I sell last month? Thus, I would look at how many blue jeans actually got sold from the first day of the month all the way through the last day of the month. All right, so you do need to understand the difference between stocks and flows. Now, we said one of the major questions we care about is how do we measure the total output or the total production of an economy? Well, we measure it by something called the nominal gross domestic product, the nominal GDP. And what that measures is the market value of all the final goods and services that were produced by an economy in a given period of time. Notice this, given period of time. That must mean, since it's measured over a period or over an interval, we're looking at a flow. Okay? Nominal GDP measures the flow, and in other words, the final amount of all goods and services produced in an economy. Now, a few things to note there. There's the market value. When we're measuring nominal GDP, I care about the value of all the products and services in the economy based on current price levels in that economy's current currency. So if you're American and you're dealing with the American economy, I care about dollars. I'm going to measure it in that day's dollars. Now, if it's in Argentina, which is what your book is looking at, I care about pesos. If it's Russia, I care about rubles. So as we move through the rest of the course, every now and then we're going to throw out different currency names. Not everything is in dollars, though certainly in the United States, everything should be in US dollars. All right, so that's market value. Notice also that the definition said it was the amount of final goods and services in the economy. It does not include intermediate goods. Now, what are intermediate goods? Those are products that are used to produce other products, and when they are truly an intermediate good, they are used up in the production of another good. So, for instance, if I use a lot of sugar to create a Coca-Cola product, I don't count sugar. At least I don't count all of that sugar in the gross domestic product, because that sugar was completely used up in the production of another good that will eventually be the final product. Once I make the bottle of Coke, I don't usually use Coke to make anything else, right? So Coke, that bottle of Coke, is the final good. And why do we not count these intermediate goods? Well, if I counted both the value of the sugar and the value of the final price of that bottle of Coke, I'd be double counting, right? I don't want to double count goods. So any good that is completely used up in the production of another good, that doesn't get counted. All I count are the final goods and services, and that's how I measure nominal GDP. And like we said, that's measuring a flow. Now let's just look at an economy, just a big picture, a little graph here, or a little pictorial instance. We have a whole bunch of inputs in our economy, and they are put together in firms. We might have some labor, we might have some capital, maybe we have some raw materials, and we put them all together and we produce things. And the total of all of those produced things, the final is going to be output. Now, should all of those inputs be used to create an intermediate good, I will not count that in my total GDP. I will only count the value of the final good when I count the total output. All right, let's look at some actual numbers. In order to calculate nominal GDP, what I need to do is I need to figure out what are all of the final goods in the economy. For purposes of this illustration, we have a very simple economy. There are t-shirts. They make t-shirts there. They make music downloads, and they make meals. So 3 goods. I look at, for any given year, I look at the total amount they produced of each of those 3 goods. And then I look at what were the current prices in that year in that country's currency. And then I do a calculation. I say, well, the value of all the t-shirts that economy produced was 10 t-shirts at $20 a t-shirt. So that actually was $200 of t-shirts. I know there were 50 downloads at $1 a download. So that was $50 in downloads. And there were 6 meals at the price of $25 a meal, so that's $150 of meals. If I add all that together, I say that in 2012, that 3-good economy had a nominal GDP, gross domestic product, of $400. Another way I can say it is that that economy had a total output of $400. Total production. Now in 2013, I just take 2013's production of t-shirts times 2013's price of t-shirts, 2013's total downloads times 2013's price of downloads, and then 2013's total production of meals times 2013's price of meals, and I come up with that in 2013 that economy produced $442 worth of goods. It had an output of $442. Looking at the United States historically, if we just want to look over the first decade of this century, we see that at least in nominal terms, in billions of dollars, this was the change in nominal GDP in the United States. Now, if you notice, it's technically gone up most years, right? Do you see the 1 year where the economy's nominal GDP did not increase? It's right here. From 2008 to 2009, we actually did see a decrease in nominal terms of GDP in the United States. By the way, just so you know how to read charts like this, notice it tells you that it's in billions of dollars. If I have 9,951 billion of something, that's like saying 9 trillion, 951 billion, and there's a 0.5 there, so $500 million worth of GDP. Just want you to be able to know how to read those charts. Looking at this on a graph, I can see over that 10-year period, nominal GDP went up just about every year except for from 2008 to 2009. Otherwise, it keeps going up. Now in Argentina, remember it's a nominal GDP, so it's in terms of their currency, so it's in billions of pesos. I see that theirs is mostly going up until 1998, and then it seems to go up and down a little until 2000, and it starts going back up in 2001 to 2002. So this is just kind of how we read a chart that's showing GDP, or total output, for those economies. You can tell that Argentina did not have a good couple of years between 1998 and 2001. Now, another thing we care about, we don't want to just measure the total amount of GDP growth for each year, right? Remember on this chart, I was seeing it in terms of pesos each year. But what if I want to know, well, how much was it growing each year? And what if I'm a person, say like an economist, where I really like to measure things in percents? Well, we have something called a growth rate. The growth rate is a percentage change in any variable from one time period to another. Now, if we're talking about GDP, it's almost always 1 year to another, or perhaps one calendar quarter to another. And a calendar quarter is 3 months long, 1/4 of a year. Now, how do we do that in mathematical terms? Well, the growth rate of GDP would be the change in GDP from 1 year to another divided by the original year's GDP. So let's say that we've got Argentina. Their nominal GDP in 2002 was 300 billion pesos. It grew by 300 million pesos in 2003. That means the change in GDP was 300 million pesos. So what was the nominal GDP growth rate from 2002 to 2003? Well, let's fill it in. The change in nominal GDP was 300 million pesos. The original GDP that we're basing it off of was 2002 GDP of 300 billion pesos. If I do that math, I get the answer of 0.001. And remember, to convert a decimal to a percent, I just move the decimal place 2 places to the right. And so what I say is the total nominal GDP growth for Argentina from 2002 to 2003 was 0.1%. Now, let's look at that one slightly different way. Remember, we said that GDP in 2002 was 300 billion pesos. If it grew by 300 million pesos into the next year, which was 2003, we're saying that 2003's total nominal GDP was 300 million pesos. Well, another way to do that same calculation we had just done, we can find nominal GDP growth rate by taking the current year's nominal GDP and just dividing it by the total of last year's nominal GDP. It's going to give you an answer of either something less than or greater than 1, which is like saying it's plus or minus 100%. So let's just look at it. If I said Argentina's 2003 nominal GDP was 300 million pesos, and I divide by their 2002 nominal GDP, which was 300 billion pesos, I get an answer of 1.001. That is like saying if 1 is equivalent to 100%, this is like saying it grew by 0.001 or 0.1%. The nominal GDP growth rate is 0.1%. So there's kind of two ways you can do it. You can either just take the change in GDP divided by the original year's nominal GDP, or you can take the current year's nominal GDP and divide it by the last year's nominal GDP and look at whatever follows the decimal point. Now, your book takes you through a bunch of math because what they really want to show you is that nominal GDP, remember we said it's the market value of the total production in the economy for a given time period. Well, market value has everything to do with price. Now, your book took you through a lot of math to show you that nominal GDP is based on the actual output in goods or units of goods in the economy multiplied by the price level in the economy. I'm going to take away all that math, and this is what I want you to care about. Price is the price level in the economy, and that's either measured by something called the Consumer Price Index or something called the GDP deflator, and we'll get to those in a little while. That number output is what we usually call the real GDP. Don't worry, we're getting there. What is real GDP? It's the measure of production in an economy that has been corrected for any change in overall prices. It's the real output, not based on price levels, not based on the market prices. It's just what was the actual output. All right, well, let's take that now. I can measure nominal GDP as either the price level in the economy times the real GDP or the output in the economy. Or what if, remember we just looked at those growth rates? Well, growth rates are nothing more than a change in something, right? A change is a growth rate. Well, I can take this same formula and say the change in nominal GDP, in other words, the growth rate in nominal GDP equals the change in the price level for that year plus, notice the plus sign here, plus the change in real GDP. Now, what are the key concepts in that particular equation? I got to know nominal GDP. I got to know the price level in the economy at the time, which is going to either be, like we said, CPI or something called the GDP deflator. And these are essentially measures of inflation or deflation, which we've covered already. And then you need to know the real GDP. Now, so overall, what's the difference between nominal GDP and real GDP? We've already said it, but let me conclude for you. Nominal GDP measures the economic output at current price levels in that economy, whereas real GDP measures the economic output at a base year price levels. I'm going to use real GDP to adjust for the fact that price levels change in an economy, and I want to be able to compare one year of GDP to another year of GDP without being concerned about the changes in price levels. So that's why we have this thing called real GDP. It adjusts for the fact that price levels change, or in other words, inflation or deflation happens. So let's look at it again. We had this 3 good economy: t-shirts, music downloads, and meals. We remembered that 2012's nominal GDP was calculated this way, and we came up with $400. If you remember, 2013's nominal GDP was $442. Now, let's assume that 2012 is our, what we call, the base year. I want to compare everything to what happened in 2012. Well, what I then need to do is I need to measure real GDP. 2012's real GDP is going to be the 2012 production times 2012 prices. Well, that's going to be the exact same thing, right? I already did that on the previous slide. 2012's output times 2012's prices, and that comes up to $400. Now, how I measure 2013's real GDP will be a little different. I'm going to take 2013's output and I'm going to multiply it by 2012's price levels. Look at that. And what I'm going to get is that the real GDP, if 2012 is my base year, the real GDP for 2013 is only $425, not the $442 of nominal GDP. So real GDP is going to be lower than the nominal GDP. And if you notice, price from 2012 to 2013 went up. Price from 2012 to 2013 for music downloads went down. Price from 2012 to 2013 for meals went up. So overall, it looks like the price level had gone up in the economy if I look at all 3 goods together. And when I have an economy that is experiencing a rising price level, otherwise called when the price levels go up, we call that inflation, right? So if I have an economy experiencing inflation, well, nominal GDP is going to be greater than real GDP, and that's exactly what we see happening, right? Nominal GDP was $442, but real GDP is $425. Let's look at Argentina. Let's pretend these were the numbers for Argentina, and we knew that nominal GDP for 2013 was 442, but real GDP was 425. And in 2012, nominal does equal real GDP because 2012 was the base year. It always matters what your base year is. Well, if we wanted to find out what was the growth in nominal GDP? Remember, we would just take 2013, the 2013 nominal GDP divided by the 2012 nominal GDP. 442 divided by 400 is 1.105, and that means 0.105 is the growth. If I move that decimal place 2 places to the right, I come up with a 10.5% growth in nominal GDP. Other way to do it is to say what was the change in nominal GDP from 2012 to 2013? Well, it was $42. The change divided by the original GDP is going to get me 0.105. If I move that decimal place to the right 2 places, I still get 10.5%. That's my nominal GDP growth. Now, what if I want to deal with real GDP growth? Well, I'm just going to do the same thing I always do. There's 2 different ways to solve for a growth rate. I can either take 2013's real GDP divided by 2012's real GDP, and I get 1.0625. That means the growth rate was 0.0625. If I move the decimal point, 2 places to the right, I get 6.25%. Or the other way to do it is to take the change in real GDP. So when I went from 400 to 425, the difference between those 2 years is $25, and I divide that by 2012's real GDP, and I come up with 0.0625. Move the decimal place 2 points to the right, and I again find the exact same answer. Real GDP growth is 6.25%. Now, what did we say on the previous slide? Nominal GDP growth for Argentina was 10.5%. Nominal GDP growth was higher than real GDP growth, and that's because we are already assuming that the price levels had more or less gone up in this economy. Let's look at some real numbers for the U.S. Since 1929, this is showing you the real GDP in the United States all the way through 2008. Now, I want you to look at the real GDP in 2009 is right here, and it was about $13 trillion. That's real GDP. Now, I just want you to go back and look at the graph we saw earlier in this video for the nominal GDP in the United States. And if I look at 2009, look at that. Just over 14 trillion. So, real GDP was just around 13 trillion in 2009, but nominal GDP was 14 trillion. If the nominal is greater than the real, well, I would expect that there must have been inflation. The price level went up. So what does that mean? How do I compare that to Argentina? Well, I don't have the exact same years, but I can just look at what happened in real GDP in Argentina. And remember, we saw almost the exact same trend in the nominal GDP in Argentina. However, notice the real GDP is definitely lower. The nominal GDP had been sort of up here in terms of pesos, but the real GDP is lower. Once again, if I have nominal GDP is greater than real GDP, I assume that there is inflation.